And we are live. What's good? What's good? What's good, family? Welcome to Sativa Sunday. It's your boy Zay. Welcome to your favorite fundamental macro and technical analysis stock market show. And as you can see, I feel a whole lot better. I do not have a cold or none of that good stuff, man. I have bounced back. Oh, it feels good to really be back. So tonight, y'all gonna get 100%, man. Y'all get a really good show. Now, before we even get this show started, first things first is I gotta give a big shout out to my wife. Shout out to my wife. Happy Mother's Day, boo. Tonight's episode is actually sponsored by my boo. She's the one that let me get a little bit of time to, just share some of my thoughts tonight. But I was like, babe, I know it's Mother's Day. Do you mind? She was like, no, it's all good. Go ahead. So she gave me a little bit of time. So it is her day. And I just want to let her know that I love you and I appreciate you for making me a daddy. Also, big shout out to my mom. Shout out to Denise Hines, for giving birth. Without her, there is no me. You know what I'm saying? And, big shout out to all the moms in the world, for real, because without moms, there's no human race. Like, y'all give birth to us. Y'all keep this thing going. So big shout out to all the moms that's holding it down, being the matriarchs for their family. Big Mother's Day to all of you all. So I wanted to get that out of the way. So now, of course, before we get into the episode and the agenda, gotta shout out all my runners, gotta shout out my Patreon family. And if you don't know, the links are in the description down in the video if you want to join either one. So shout out, big ups to all of them. Special shout out to my sponsor, Kaniba. And their website is down there below. So tonight, guys, got a really good one. The episode is called Stock Market Purgatory. So we've been going sideways for 40 days. We've been stuck for 40 days. So we're going to break down the reason why we basically been stuck for 40 days. I got all the data laid out and just how we got here and, kind of what can get us out of this range. You know what I'm saying? What can get us out of this stock market purgatory is what I would like to call it. So we will get into breaking down some of the macro things, some of the fundamental things, and some of the technical things that all lead to just this mixed bag of you can be bullish, you can be bearish. It's really a neutral state right now, but we just want to go through everything and see what can get us out of this. Now, before we get started, go ahead, drop a comment. Don't forget to press that like button and hit the share. We want to get a few people on, as well as don't forget the subscribe button, as well as the little bell, so whenever I do a video, you get those notifications. And for those that are going to be hanging out with me tonight, look, like I said, I know it's Mother's Day, so I appreciate your time. I'm even try to get this done within the hour, so that way you can go back to spending time with your ladies, your wives, your moms, or whatever. And that's how we're going to do it. So with that being said, I'm going to holler at a few people in the comments. I see I got my guy Brian. He said, let's go. What's good? My boy Dre, man, happy Sativa Sunday. Happy Mother's Day to all the moms. Let's go. He said, hit the like button. I appreciate you. Black Swan, what's good, my brother? And then Douglas said, what's good, fam? How you doing, man? All right, y'all. So let's get right into it. Let me share my screen. Let's get us going. And tonight, y'all gonna get the Asana special. I'm gonna get the Asana special. Let me pull this up. Let me make sure we good here. Give me 1 second. All right, there we go. All right, so hopefully, let me zoom in because I feel like that screen be just so small, man. Hopefully, y'all can see that. That looks better when I look on my screen, so I'm assuming this is good looking fine if y'all on the computer. But just let me know in the comments if y'all can see that. So, like I said, man, today's episode is stock market purgatory. So we've been going sideways for 40 days, right? And just this past week, if you watched last week's episode, I thought CPI. Which is the consumer price index. I thought that might be the catalyst that get us out of this trading range, and we'll go to the technicals later, but it didn't. So we basically have went nowhere. So what we're going to do today is just kind of really examine the reason why we have been stuck, right? So there's a couple of things with this market is that number one, the macro data is very mixed. So is the fundamental picture, and so are the technical pictures. And we're going to break each one of those down, right? So we're going to start with the macro, right? So economic data. So we talked about how it's going to be very important for this market that these things, essentially, these macro reports would have to, would play a part, right? Now, when we think about the NFP and the jobs report, we have a job market that is still very resilient, right? So that doesn't necessarily go towards the bear case, right? Or an economy that's tanking, right? We for every one worker, there's two jobs, right? And unemployment, if we go check, right? So I had this data already ready. Unemployment is still at record lows, right? So we just got our last unemployment reading. It was at 3.4%, and we're at record lows. So people can get jobs, right? And then when you look at as far as adding jobs to the economy, the last report came in hot, right? We added 253 jobs versus 181,000 expected. Now, some of that could be attributed to, the travel, leisure, and just summer hiring. But at the end of the day, when you look at JOLTS and you look at unemployment claims, there's still more jobs out there than workers. So until that imbalance gets fixed, we're going to just have this very, very resilient labor market, right? That's one aspect of the economic data, right? That kind of presents this mixed picture. The next part or the next piece of economic data that we have are the inflation readings, right? And as we've been seeing, inflation has been going down, right? And I have some data that we can look at that kind of shows this. Now, this is a inflation heat map, right? This is a heat map that shows how inflation is declining, right? So if you look up here, this is basically the headline CPI, core CPI, right? So this is 2021 when things were, when it's green, it's kind of like it was good, right? And then when we got to 2022, this is June, that red box, that's when it was like, 9% inflation, right? So it's very high. But here's what the key part is, right? Since June, if you look at headline and the colors, we have been on a decline since then. And it's been, a straight decline from June. It was 8.9. July was 8.4. August 8.2. September 8.2. October 7.8. November 7.1. December 6.4. January 6.3. February 6.0. And then March we got 5.0. And it's missing April, but April came in at 5.0. So one of the mandates for the Fed this year was that they wanted to get inflation down. Now, if you look at the headline number, it's going down rapidly. And at this current rate, the federal funds rate is basically in line with headline CPI, right? Now, when we get into core, that's a little bit different. And this is where like the inflation argument, it gets sticky, right? And this is what causes the uncertainty is that, okay, you have one side or one camp arguing that, hey, headline inflation is on a steady decline. But then you have those who will say, well, let's look at the core, which is, X the gas and X the housing, right? Well, when you look at that, it's a little bit more sticky, right? And that's called, I wrote it, it's called super core. So he's looking at, basically the services industry. And he's saying, and Jerome Powell, when I say he, which is the FOMC chair, what he's saying is that it's more sticky, right? And as you can see, the last reading was 5.6. And I believe we can go look and see what it was this past week. I don't know if they show us the core. I would have to look to see what the core was. But I do know that the headline was 4.9. The headline came in at 4.9. So April was 4.9. So once again, you have inflation going down. You got the super core, which is kind of like moderating, but not at a fast enough pace. And you have high interest rates, like I mentioned, Jerome Powell. And if we go take a look at that, let me pull up that data, right? This is the Fed Watch tool here. Now everybody should know, if you're not aware, the federal funds rate is now at 5 to 5.25, which you can see right here. So let me just zoom in a little bit more. So we have our next meeting in June. So this is the pricing for June, or the expectation for June with our higher interest rates, right? So at the next meeting in June, the market is anticipating that the Fed is going to pause. Based on the macroeconomic data that we just reviewed, the market is pricing that, hey, the Fed is going to pause, right? And we haven't even covered everything yet, but just going through this tool. Now, something that I learned or kind of just picked up is that you can hit this compare button. And if you hit this compare button, it tells you like the changes. Now, last week, right? So last week, May 5th, the percentage for a pause was 91%. This past week after this past week, it dropped down to 85, meaning the market went and priced in a little bit more of, okay, the Fed might have to do one more, right? And what could have caused that? Well, that hot NFP report, when we got those high jobs and all, and the low unemployment, they're like, okay, well, maybe he might have to. And then when we got the low CPI and the low PPI, they was like, well, again, that's that battle. Well, inflation is going down. So does he really, can he manage this tight labor market while inflation keeps going down? That's one of like the main arguments is, can he subdue inflation without weakening the labor market? That was like one of his goals. That was one of the objectives that the Fed has set out and talked about. And right now, it seems like they kind of doing it, right? I mean, it is what it is, right? So you got that aspect, right? So let me go back to my assignment to keep me on track here. So we went through the inflation readings. I showed you kind of the heat map, and we see that that's going down, right? So next is you have retail sales and consumer sentiment, right? Now we get retail sales this week. So we'll find out what consumer spending is looking like. Now, the last time we got it, it was down. And so that just speaks to like, are we going to see, if they keep saying that, are we going to see a recession? Then are consumers changing up what their spending habits are? Another good segue or something else that is going to happen this week or just in the overall scheme of things is that we do have retail earnings this week, and I'll share the calendar in a minute. But we're going to get more. This is going to be a heavy week where we hear a lot about the consumer and what's the strength like, right? Now, if you've been watching the Keeping Up episodes, the consumer has had a lot of strength, and I keep kind of iterating that like somehow we strong. We ain't went through all the savings yet, so it's holding up. So it's like, is the recession really here yet? Because the consumers is really kind of now, mind you, take that with a grain of salt because credit card debt is at record high. So again, it's that battle of you got bullish sides, you got bearish sides, right? And it's crazy how it's just creating a mixed pot. So that's consumer reports, right? That's consumer reports. And then the last part of the macro picture would be the PMI. So we've been getting like the flash services and the ISM report. So on Monday, right, just to make all of this relevant, as we come into this upcoming week, let me get to this upcoming week. We get the Empire State Manufacturing Index, right? Now, if you aren't aware of what these are just different indexes that, Philly has one, New York has one, different areas have one, and they survey different, businesses as far as like how do they feel their business is going. And so with these readings, they basically use it to say, hey, are we in contraction or is the economy in expansion? Now, as of lately, if we look at this graph, you can see it is kind of chop suey, right? Again, it speaks to the sideways action we're seeing in the market because are we in contraction or are we in expansion, right? Like we're just all over the place, right? And we're seeing that in all of the areas, right? Some months is good, some months is down. It's like we're going through that normalization process. So again, can you really count on this data? Yeah, it really doesn't give you much to go on, right? So like I was saying, right, the macro data is very mixed, right? So as we just went through, so just to recap there, right? We have a resilient job market where for every one worker, you have two jobs. You got unemployment at record lows. However, you got inflation, you got headline inflation coming down at record, pace, right? However, you have sticky core inflation. So it's kind of like not coming down as fast, right? On the other end, you have a pretty strong consumer, right? And we'll get confirmation of that when we see the retail sales and all of that this upcoming week. But then on the flip side, you got an economy that's showing you that it is slowing down, right? And that's the biggest thing is that you got an economy that's slowing down, but it ain't breaking, right? A lot of people expect for the economy to break, but it hasn't broken yet, which gets me into some other aspects of the macro, right, that I didn't really get into. So now let's talk about the banks a little bit, right? Because That's a part of the macro situation, right? Tighter financial conditions. So one of the questions that we asked earlier was, is the banking crisis contained, right? Or do we see more fallout? Well, clearly we've seen more fallout because more banks have went belly up. So it seems it's not contained yet. And we are seeing that now banks are having tighter conditions, and Jerome Powell has spoke to how that is going to again could slow down the economy, right? But has that really kicked in yet? We don't, we're starting to see the effects of that. So we're going to start to see more and more of that. But this is just definitely something to kind of keep your eyes on, as far as that we have these tighter conditions, more banks are going belly up. And so that's like one of the things that continues to linger over the market, right? And then the last thing from a macro perspective is the debt ceiling, right? And man, I brought up the debt ceiling a long time ago, and I was like, yo, we're gonna back pocket that. But I've been tracking, like, okay, these debt ceiling discussions eventually is gonna come, that rooster's gonna come home to roost, right? And so I was doing some research about this debt ceiling thing. Now, there's a couple of things we need to know about this debt ceiling thing. Is that, number one, the United States has never defaulted on our debt, and I don't think we're going to start now. However, we've come close, and that was 2011, and our debt got downgraded or something. I think it was our debt got downgraded. Now, a couple things that came in the news is that, as you can see here, I have a due date of June 1st. So that was kind of like the date that Janet Yellen mentioned, like, hey, if we don't come to an agreement on this debt ceiling thing, the country could default, and it will create economic chaos. Now, they're using a lot of language to create fear around this debt ceiling thing, but we've been through this time and time again, and they always reach a deal where everybody not gonna be happy, but it gets done. The United States not going to default, and they just use it as like a scare tactic. Because if you just look through history, we've had these battles multiple times, and it comes down to them 12-hour negotiations, and they end up getting something done. So I personally don't believe that the United States is going to default on their debt. They'll come to some terms. However, it's not to say that in the lead up, it won't create volatility. So as you all know, this upcoming week, President Biden and Secretary McCarthy are supposed to meet to have further discussions about the debt ceiling. So they were supposed to meet on Friday, but they end up delaying it to this upcoming week. Ironically, they would do it that way. So again, one of those catalysts that is hanging over the market, right? And could serve as that catalyst that could cause the breakdown or the breakout, right? Because here's the point that I want to make on the debt ceiling discussion. Everybody is talking, and I when I say everybody, I'm talking about, like, when I went on YouTube, everybody's like, oh, the debt ceiling, it's going to cause a pullback. This is the catalyst that's going to scare the market, blah, 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 blah. But nobody's talking about what happens if they make a deal. If they come to terms, that risk is no longer lingering over the market. Don't you think that could serve as the catalyst to actually go, and don't let the market still be hovering where it's at in this little 4136 area? That could, that would catch so many people outside, because so many people are bearish, thinking that, oh, they ain't going to get a deal, or, oh, the U.S. is going to default on their debt. That, what if you get a surprise and somehow they work out a deal? Right? You have to be open to both sides. Like, again, they don't want to see the country default. Like, they want to pay bills. They want to pay the Social Security and all that. So, like, see through the noise and be like, yo, you know what? Am I missing some? And the missing some is, what if they reach a deal? A lot of people are not positioned for that. More people are probably positioned for if the U.S. default. Because there's so many puts out there. Like, it's crazy. So, when it comes to the debt ceiling, I think, you have to consider, like, yo, yes, this could be a bad thing, but what happens on the flip end when they make a deal and we're past this and this is no longer hanging over the market? Like, you once this thing is gone, okay, what's next? Like, if this doesn't, because the reason why I say this is because bears have been waiting on a lot of things for the market to crash, and the market ain't crashed yet. So what makes you, if the regional banking crisis didn't have us go below 3,800, what makes y'all think the debt ceiling is going to do it? Is my thought. I hear people saying that, but like if that didn't do it, then what made you think this is going to do it? Especially if they reach a deal. So that's just something to consider, right? Or just something that, that's a risk that's been like kind of lingering or hanging over the market from a macro perspective, right? And so, yeah, that's pretty much the macro picture right there. Now, what I want to do is we're going to transition into the next part, which is the fundamental picture, right? This is pretty easy, right? So when it comes to the fundamental picture, let me scroll over. It's all about earnings season, right? And I have some data from, shout out to Charles Schwab for the Weekly Trader Outlook. They published it this past week. But if you look at this earnings season that just passed, it was actually better than feared, right? The earnings season was better than feared. Like at the end of the day, I remember thinking that quarter one numbers would be worse than quarter four numbers. Hopefully y'all can see that. I'll zoom in a little bit, right? So last quarter four numbers was 70% EPS beats and was at 58% on revenue beats. This quarter so far has been 77% beats and 68% beats. And as you can see, so far 91% companies of the S&P have reported. So also from a growth standpoint, quarter one earnings are down 3.9% year over year so far versus an estimate of negative 6.6, right? So better than expected. And revenues are actually up 4.3% year over year so far versus 1.9 estimated. So again, now I know, so let's get into the nuances once again, right? So the nuances are is that, okay, some will say, well, the bar was lowered, right? A lot of companies revised their numbers, and so they were beating lower estimates. True. So you have to look at the guidance. Well, some people probably are sandbagging, but the guidance kind of came in unchanged, right? And again, doing some research, it's basically been like this. If you've been meeting or beating your numbers, the market ain't really been rewarding that per se, like, with big upside beats aside from like the big companies. But if you've been missing, oh man, you've been getting smacked because a lot of earnings have been priced for Armageddon. So if you are doing worse than Armageddon, then that's why you'd be seeing some of those high price companies that go down 50% when they miss earnings. That's the reason why, right? But overall, when you look at the earnings season, you have to say from an S&P 500 standpoint, which is the top 500 companies, not, so a lot of those companies that be getting smoked are like, the NASDAQ darlings and stuff like that. So they're not really included in this number. So at the end of the day, earnings season was better than expected, right? So it's like, and you have all these people, myself included, who say valuations are high. And we're going to get to that point because valuations are high. But I did an episode, will earnings justify the price? And we talked about it. I mean, nuances, right? Bar was lowered, so what? They beat, and you could say currently at this point in time, earnings did justify the price because you had a lot, you had 77% beats and you had 68% revenue beats. So the earnings season did a little bit better than expected, right? And so let me segue into the valuation piece, because now that earnings season is over, that goes right into the valuation part, because like I said, I wanted to get into that. Now, I do personally believe that the market is a little bit overpriced, and there's a couple things that I'm going to show you as to why I believe that they're overpriced. Number one is, now let me just show y'all some quick year-to-date numbers. So this is market performance year-to-date. Just know that the top three performers are communication services, XLC, you got tech at 22%, you got XLY, consumer discretionary, all cyclical, right? And it was also the worst three performers. I'm gonna keep recapping that. And then you got consumer staples here, which is odd because that's a defensive sector. But then when you look at the bottom four, you have energy, financials, utility, and healthcare, right? All defensive. However, you got this cyclical company, which is, again, this is why the market is stuck halfway, because typically when the market is in rally mode, financials would be up here participating along with communication services, tech, and consumer discretionary. it wouldn't be staples, right? And that's why you can't be overly bullish or overly bearish, because when you look down here, you're like, well, the defensive sectors is like not really doing nothing. They lagging. But energy is the main one that's getting whooped, but everything else is just kind of like flat. Right. So it's a very mixed picture, right? Now let me get to the valuation part. That's why so here it goes. So when you look at the S&P, we're up 7% year to date, right? And the forward PE is at 18. Now let me go to my JP Morgan information here real quick and show you guys some valuation charts. Is this the one? That's not the one. This is the one. Here we go. All right. Let me show y'all that. So this right here is the S&P 500's forward PE ratio, over from 98 to 2022. And what you see here is this is the 25-year average at 16.80. One standard deviation above that is 20.14. And then one standard deviation below is 13.46, right? Now, as of April 30th, we are at 18.2. So we are above the 25-year average. Excuse me. So we are above the 25-year average, and we 2 points shy of one standard deviation, which is like when 20x multiple. That's expensive, man. That is, you don't really want to, from an investor standpoint, that is a really, that's when you want to be taking profits, you know what I mean? And when you want to buy is when we're, of course, one standard deviation away, because that's when you get a discount, right? So at the current time, the market is above the 25-year average. However, there are some things that just don't line up with that valuation. So I'm going to share those with you real quick. So let me actually go pull up some charts real quick, right? And we're going to go look at a couple of indicators. So there's a couple of if you've been following me or just following my videos and stuff, there's a few indicators that I've been sharing, but I'm gonna go through the handy dandy ones. So first of all, the S&P, right? This is the S&P 500 stocks above the 50-day moving average. So right now, we have only 45% of stocks are above their 50-day moving average, right? We also only have 46% of stocks above their 200-day moving average. Now, this goes to speak to like how only a couple of stocks is really doing the work. We're going to get to that in a minute. And then overall, the overall market, so that those two indicators are just for the S&P 500 only. But when you look at just the total percent of stocks above the 200-day moving average, the overall market, only 39%, roughly about 40% of stocks are above their 200-day moving average. So I say that to say, and let me go back, to have the S&P 500's PE at 18, excluding the all percent of stocks, but just going to our main two indicators of 200-day and 50-day, we only have half above those averages. That's not a very healthy market per se, right? And most people know that a lot of the gains have really been attributed to a certain class of stocks. And if we go to Wells Fargo, they got a pretty dope graph that I can show y'all, and it shows it. So this is the S&P 500 sector performance with FAAMG. Now that is Meta, Amazon, Apple, Microsoft, and Alphabet. Look at that. 43% year to date between just them companies. Everything, and then you got Infotech, which that's them included in communication service. That's your Google. So the three that's popping is everything. That's it. That and then if you throw in Nvidia, right, from the chip sector that's been running. So the whole AI, anything AI theme is and mega cap has like been crushing it, and they are accounting for all of or majority of the year to date gains, right? And so. With that being said, is the market appropriately priced, right? From let me fix that. From that aspect, I have to say that is a bearish indicator for me, right? Now, remember how I said it's a mixed bag. That's just one thing that is that's mixed, right? So we went through the valuations, showed you that. We went through the moving averages. Let me get to my notes, my bad. And okay, so now, right, we're gonna get to some technicals. Now we're gonna get into some technicals, right? So now we get into some technicals. I'm gonna share with y'all real quick what Charles Schwab said, right? So with little change in the SPX or the VIX, the technical outlook has not changed much, right? And that's pretty much my saying. We've been sideways for 40 days, but I'm gonna get into some of that in a second, right? Equities continue to confound the naysayers by performing much better than most expected year to date, right? Despite a debt ceiling battle, so we talked about that. Persistent inflation, we talked about that. And then ongoing recession warnings, right? So we talked about some of those indicators that talk about a recession or not, right? That would be like your labor market, those manufacturer readings and stuff. So then you have the SPX remains above the 200, 150-day SMA, which is 40.57. And the long-running consolidation around 4,100 is now on its sixth straight week. Right now, this is why I say, a breakout or a breakdown is brewing, right? Because, we've been in this zone for 6 weeks. Eventually, we're going to get out of this zone. At this point, right, falling back below the bear market low of 35.77 from last October would be a decline of more than 13%. This is what I was talking about earlier, which is, do you really believe the debt ceiling and the regional, the bank crash, or all those risks? Let me go back to the risks. Do we believe that the risks that I have listed, right? Where we at? Right here, right? Inflation remains elevated. Does he do another rate hike? Banking crisis, debt ceiling, too much bearishness, right? Is all of that going to be enough to push the market? Push the market back below, more than 13%. I don't think so. I just don't see it. I just don't see it. However, right, while a rally sufficient enough to declare a new bull market, which is 42.92, is only less than 4% above, right? And so from a strictly technical perspective, the market doesn't seem too excited or too worried about anything at the moment. And that's basically what they said, right? So now what I wanted to share, though, from a technical perspective was a few things. Where was I going to go? Oh, man. Okay. So, first things first. Let's go look at SPX, right? And I'm going to remove that. And I want to just show you guys one thing. Last year, right? Last year, the SPX lost 926 points total. Now we're just gonna keep some stuff simple. Where's my calculator at? Let me get my calculator up, because I was just playing around with like some different things, and I want to show y'all just like some simple stuff of just how like a lot of confluence, right? That just points me to a certain outcome. Number one, we lost 926 points last year, right? Now, if you were to divide that in half and say, we're gonna get half of that back, what does that give you, right? So you just divide that by 2. That gives you 463 points. Now, what I want to show y'all now is we closed the year at 38.39. Okay, 38.39. Where the hell did my calculator go? There you go. All right, let me get that back. So remember that 38.39. Now I'm going to add, that's 38.39, and you get 43.02. So if you were to get back half of your points, 43.02. Now we all know what 4,300 means, right? That would be like a big level that's close to the August high, right? February or August high. And this is just some of the confluence that I want to show you guys. So that's one confluence. Another confluence is, let's go to a monthly chart, right? And let's really just break down some technicals. From a monthly perspective, we have, basically snapped September's high, right? Which in theory, when we made this big sell candle, we came and swiped them lows and made our October low. And now you would expect for us to reverse and attack some highs, right? And this is for just from a monthly perspective. So we've now been attacking September highs, which is 4120, right? And ironically, we're at 4124, right? And that next set of highs that we would attack would be the August, which is 4325. So that's another confluence of just technical saying, hey, okay, we took some lows. Now we should be looking to retreat and take out some highs, right? Another confluence, right? Let me go add my yearly fib levels. Now, if you watch my beginning of the year video, I go from low to high because we want to see a retrace of this move. And when you do that, when you get to the 0.38 or to 0.38, which would make it like basically a bullish run, that gets you to 4311. That's another confluence, right? So it's just like a lot of signs are pointing to, okay, does the, as the market has been absorbing all of these orders in this area, of course is going to make a violent move, right? So if we go down to some lower time frames, ultimately what has to happen is, as long as the market doesn't, re-break these lows at 40.55, potentially down to 40.80 could be support, and you could absorb some more orders. And then ultimately you could be looking to make that move to then attack, the August highs, right? But it just feels like when you go through all of that mixed data and you look at the technicals and you kind of just simplify it, you ask yourself, what is the catalyst that could get us out of this rut? And what do we have left that could do it? And, a lot of people will say the debt ceiling. So what I'm going to say is this is where I'm going to end it, because this is the research I did where a lot of people are saying that what's happening now is very similar to 2011. And so I want to just tell y'all what the outcome was, what happened in 2011. In 2011, when they did the debt crisis thing, literally they're saying it lined up. Back then in 2011, the market was up 7% going into May. We up 7% going into May. They said the next 2 months we went sideways, meaning June, July, the market went sideways. This is 2011 I'm referring to. And then eventually it did, pull back. Now, if that were to play out similar here, but let's just say they get a deal, right? Because if the technicals are strong, and let's say they get a deal, we then end up running and getting these highs. However, something, inflation creep, whatever it is, once you take out these highs, you expect to pull back a little bit. But as we know that there's going to be some more risks on the back end of the year, which is why I have the second half recession correction kind of as on the horizon, due to the factors we talked about. How perfect would it be from a narrative perspective that they somehow get a deal on the debt ceiling that allows the market to then break out and take the August high? Now, mind you, that's going to be before June. Don't forget, we got June FOMC as well as June quad witching coming, right? You don't get your sell in May because a lot of people, that would mess up. A lot of people would then start to chase, right? Because if everybody's expecting sell in May, and if we go down to a smaller time frame, and this actually does turn out to be a double bottom, and you get a squeeze into the end of the month, and that's why this week it's going to be a very interesting week. But don't count out, could you get a squeeze going into that Memorial Day weekend, because that's typically a good time in the market, right? Going into Memorial Day weekend. So don't forget that either. So there is a lot of outcomes, but just from a narrative perspective, you swipe down, you go get those highs, but then now we took out the highs, we're into June, and the story starts to play out. So we'll see how that goes. But that's just one aspect of it. Then you got, I would just say, you do have the bearish aspect, but we're seeing a lot of wicks and a lot of orders absorbed. So really, in order to really, like, from a bearish perspective, you got to see a full break of this 40-50, coming down in here into these zones and start filling these gaps. And the question really is what causes that for me? Because usually when you get like a downside snap, it's usually something bad is happening where the market wasn't prepared or some unknown risk that just came out of nowhere. A lot of risks are known. So what's not unknown is positive stuff that after 40 some odd days of going sideways and consolidating under the 50% retracement level, which is 4155, right? If you do a yearly fib on the SPX, right? Or I'll go to a monthly. If you just do a yearly fib, we are at the 50% retracement from the high to the low, right? We right at that 50% tracement at just 40, and we're consolidating here. So, if we do get that breakout, it's going to be a straight shot to your next fib, which is the 0.618, right? Which is 4,300. And I've been talking about it and talking about it and talking about it. If that happens, man, it's going, it's going to be crazy. But on the flip side, this is the mixed part, right? Is that I need everybody just to remember that number one, valuations are crazy, crazy high, right? We are at a forward P of 18. Not to mention, if we get up there, it may not be the best of healthy rallies, and that it's just a few companies taking us up there, right? You got to remember that only 45% of stocks are above the 50-day, and 46 are above the 200-day. So if this stuff don't start improving, then I have a hard time trusting that rally. I'm right. Like the rally can happen, but I'm saying don't necessarily. I'm not going to trust it, right? But that's kind of like how this market purgatory, just where we are, and just when I looked at all of the data, and when I was asking myself, what could I do for this episode, and I'm gonna just stop sharing for a second because I'm pretty much done. And I'm gonna go to the comments, but I was just like, what can I do for this episode? To just help people. And I was just going through it, and I was just like, for real, all I could do is just tell y'all and show y'all the data as best as possible. And it's a mixed bag, and then I'm neutral. It could go either way. You know what I'm saying? I just I know there's a couple probabilities that I'm planning for, that if I see it play out, I'll just, let it do. And then I have reactions that I want to, play off of that. You know what I'm saying? And I've shared, some of the probabilities as far as just us possibly, breaking out to the upside. Cause I talked to a few people, man. And, when you just simplify what you see, the market is technically bullish, man. You know what I'm saying? And the macro picture is a mess. The fundamental picture is a mess. You're not really getting no help. And so you can really argue it from both ways, right? And so if you just take it from a purely technical standpoint, like I said, we made that low in October, and it's all about, are we, we chasing the next two set of highs, which was September highs, and then you got the August highs. We've already gotten September highs, and now it's like, we basically consolidating right where all it takes is just one catalyst. We can spring up, and it's gonna be a straight shot. We take out those August highs, and then from there we back into maybe market purgatory, or who knows what the hell is going to happen at that point? Because it might be pandemonium. If the market gets to 4,300, people are going to be losing their goddamn mind. There's gonna be so much forward. Like, oh my god, the rut. Like, just we gonna have so much to talk about this second half of the year, man. But all in all, man, like I said, I hope that I share some good info. Like I said, I went through a few charts, just different data, to kind of just talk about why we've been stuck sideways and why the market, you can see why it's been such a tough environment this year, because the data is just very mixed. It's not very clear. We're basically on standby for what Jerome Powell's going to do. And it's just we're just waiting for this recession, and, the consumer's still strong. So it's just, at the end of the day, what I just been telling people is just be patient, just wait. My guy Chief, he said the best thing, just take small wins. And honestly, from personally, shout out to the future traders, because they've been eating, right? With this sideways market, with futures, you can eat. So shout out to the futures traders. You know what I'm saying? They can eat, but, I just been kind of telling myself, I felt outside of, 5, 10, maybe 15.20, point wins, this for a swing trader, position trader, anything like that, you have to be really good at picking them. But it's been a tough, even then you got to be sharp with it. But it's just been a really, really tough environment. You know what I'm saying? And hopefully soon, but I'll say this is what I wanted to end with. When we break out of that zone, there will be opportunities to swing that trend for the breakout, because we're going to attack either that high, right? So let me share my screen with SPX, because I'm going to show y'all something real quick, because when we do break out that zone, baby, oh my, let me get rid of that. So if we break out this zone, right, we definitely are going to like attack this high. Like if we get above 4,200, there's no doubt in my mind that we will squeeze to get to 4,300, because there's so many stops above 4,200 that if we get above 4,200, this just the stop loss trigger alone might squeeze us 50 to 100 points, which gets you to 4,250 to 4,300. And then you just look at it from a technical perspective, it just feels like it looks like the market wants to go attack those highs. Once you do go attack those highs, there's going to be some pretty good opportunities for that then to pull back into this range and that zone. So that's going to be, so you can, for those who like to play breakouts, eventually you might be able to get this breakout trade. Once it breaks those highs and consolidates, you might be able to get that pullback. Now, if we're expecting a second half recession, though, them second half swings where if we take this high and that second half recession do play out and we come all the way back down, oh, them swings are gonna be lovely, because that's gonna be the one. That's gonna be the real trend. You're gonna get that breakout. Everybody gonna be yelling bull market, bull market. Like I talked about in the return to normal episode, we take out this August high. Everybody's yelling bull market, and then they do the rug pull, and we go back into that bear that second half of the year, and all them swings gonna be lovely. So I kind of gave y'all an inside scoop to some of my probabilities of how I'm thinking this may come out. But at the end of the day, you just gotta sit back and let it play out, take it day by day. You know what I'm saying? But I don't get lost in the sauce. Like I've been, I did a couple episodes. Don't get lost in the noise and trapped in all that day-to-day stuff. I know it sucks. And I mentioned that in another episode. I said, we might go sideways and that shit's gonna suck. I went back and watched that episode. It's here. However, if you are patient, opportunities are about to be presented. Like I said, some big moves are brewing. And when it happens, you definitely want to be in position. Shout out to my guy Trap. You want to be in position. But with that being said, man, I hope everybody has a great night. Again, I want to shout out to all the moms. Big shout out to my wife. Happy Mother's Day, boo. I love you. Thank you for letting me do this episode. Shout out to all the moms out there. Again, please make sure y'all like, share, subscribe, share this video with somebody, anybody, and help your boy out. Until next Sunday, right? I hope y'all all stay blessed and have a great night.